Welcome to your CPA's take on real estate. I'm your host, Daniel Roccanti, here again with Kyle Paxton on another video. Today, we're going to talk about getting more from Yardi or whatever property management software you're using. Most real estate firms, they have an enormous amount of data sitting in Yardi or the property management software. And is it really helping them to the full max potential, or is it just helping their accounting team close the books? With this tremendous amount of data sitting in your property management software like Yardi, this data right here should be helping you make better decisions for your activity and for your firm.
Yeah, Daniel. So, we throw around Yardi a lot. We really like it as a software platform. And just about every video you and I record, I'm talking about getting access to that real-time data, right? Really easy for me to throw in that buzz line, that quick one-liner on, hey, we got to get real-time data. But what does that actually mean? To your point, in the accounting world, in the AI era, we're implementing new softwares. It feels like every day to better our practice and what we offer. But purchasing Yardi isn't actually implementing what we need to do, right? It's being very intentional about now I am able to amass immense amount of data in real time. How do I create the, proper processes both within the software, within my team to actually optimize the software and make it useful to where you're not just bombarded with data. But we like Yardi as the flagship property management accounting platform. There's, so many shapes and sizes Yardi can fit in many different businesses that can really implement Yardi effectively. And we're going to spend some time kind of going through what that looks like today. Well, ultimately, it's in this age, we have to be able to harness the max amount of data that we can get in real time and distill it down into ways that we can actually use it and make real-time business decisions off.
Yeah, Yardi is often underutilized, and because it's mainly will be used as an accounting software, and it's an amazing accounting software, but it's just so much more than that. But it's so much more than just getting into making sure I have good reports, good ledgers. You really want to get into, hey, what is that next level that Yardi can bring to my business? And it really starts getting into real-time dashboards versus static reports, okay? Static reports still matter. Kyle and I are CPAs. We love our financial statements and our trial balances, and these are needed, okay? But you need more than just that if you really want to do a high functioning business. Because static reports, they come out, they need to be reviewed. Real-time dashboards give you that data instantly to help you make your business make better decisions.
Daniel, I see this come up a lot with so when we're talking about static reporting, right? And in the real estate space, a lot of times this comes to the surface, just kind of ignoring the actual business operations and management side through the lending space, right? You're trying to refinance, close on a loan, whatever it is. And the bank's looking for reports and an understanding of your financial situation. And a lot of times we are helping our clients pick up scraps from 2 years ago to get some static reports from 2 years ago to give an indication on how my business is doing, right? We can do better than that now, right? So, both in that more kind of compliance space and then just actually as a business owner being able to make decisions, we can really capture that movement in more real time. And so we're talking about Yardi a lot. That's our main focus for this video because we really see that Yardi is one of the softwares that really move the dial in this space. We use QuickBooks with a lot of our clients, but once you get into the real estate space, you have a wide range of what you are properties you're managing, different types of reporting. You have rentals, you have flips, you have wholesale activity. You have a multifamily property, several single family rentals, right? As all of these kind of inputs get more, your accounting records and real-time data gets more complicated with all these different inputs. You really need a robust data source and software that can really help distill all of this down and have an understanding of how the heck your business is doing, right?
Yeah, your business needs static reports and it needs something a little bit more timely. So real-time dashboards is usually going to be the answer here for that. And so static is always telling us what happened, giving us historical data. And this is usually reviewed and approved. It takes some time to get these final static reports, okay? Dashboards are going to be a lot more quicker, and it's about what is changing and what do we need to do now to act. Okay. Whether you're management or an investor, a lot of this information, you need both. Okay. And we do a really good job with the static reports, not as much when you start coming to this real time data. So let's start going into, all right, if we're going to start building these dashboards or use Yardi to have dashboards, and Yardi has built in dashboards, it's really nice. And then it also has the ability to make custom dashboards. Okay. So what we're going to get into is what are some custom KPIs, so key performance indicators that really these fund managers should be tracking. All right. Kind of the first category here is kind of operating performance. All right. And there's tons of KPIs. Kyle and I know. All right. So you really need to make sure that when we're looking at KPIs here, we're identifying what ones is best for you and your
Yeah.
business. Because if you're looking at a million KPIs, you're really not actually looking at any KPIs. Hey, it's data overload. So you need to just come in here and take, all right, what out of these operating performance KPIs are most important to me? So when I'm looking at my office performance, operating performance KPIs, I go, all right, what's ones that stand out to me? And so we're just going to use general terms here for most real estate firms. Okay. So I care a lot about my occupancy. I think most landlords do,
Pretty
right?
important, you know?
So when I'm looking at my operating, I want to know what is my occupancy, and I want to know what's my physical occupancy and what's my economical occupancy. Okay. And this is different. All right. Physical occupancy is what units or space is actually being occupied, right? But then economic is more potential. All right. What percentage of potential rent is actually being earned? So I start factoring in vacancies, concessions, discounts. We always forget, like, hey, that's great that it's occupied, but maybe I had to offer a lot of concessions and discounts to get it occupied. So I'm actually potentially missing out on rent because I'm not renting it to its full potential. That's where economic occupancy really matters for ours and it oftentimes it's actually more important than physical occupancy because maybe when I look at my physical occupancy, oh, I'm doing great. It's 95% occupied, which is pretty high in the real estate space. But then I'm looking and I'm like, man, over 50% of these, I've had to do some kind of discounts or concessions. So yeah, it's fully occupied and that is great, but it doesn't tell me the full story here when I'm in it. What are some other great operating performance KPIs, Kyle?
Yeah, so there's a huge list, and we can get down, and again, this is sliced in a lot of different ways depending on what you need, right? So, just thinking through like, what are those delinquency trends? What do we have? What bad debts do we have? Uh, Leasing velocity, renewal rates, rent trade outs, concessions. All of those things come into operating performance. Um, and then, one thing I want to kind of make sure that we're talking about with these dashboards is really slicing the like it. We want to look at these metrics both at the macro level and a micro level in a way that makes sense, right? So, like drawing the connection to what we do internally at James Moore here, we swap out real estate for people to some degree. And that's a rough comparison, but in a given few 5 minutes, I can get a good pulse on firm performance in certain areas that we track closely, and then distill it down to individuals and how those individuals are conforming. That helps me as a coach. That helps me further the business, both from the macro level, and then distilling that down to just those individual people of property, right? Um, so I want to make sure we drive the point home as we're talking through these KPIs that there's a million out there, and to your point, like just distilling down what we actually need and is very important in this.
Yeah, and the whole point of KPI is I'm getting data instantly. Current data. It doesn't always have to be the most accurate, but it gives me, if my occupancy starts dropping and I'm waiting on historical data to get to me, I don't have time to make decisions. Okay. So KPIs like operating, talk about occupancy. I also want to see rent collection. All right. Maybe my occupancy is high, but I'm starting to not actually be able to collect. Okay. Am I really collecting here? Okay. And then I usually want to see my net operating income versus budget. This is a really important one to me because, all right, what I budgeted, how does it start differing? And you're never going to be exactly on budget, but what are the big swings? Okay. This can usually show whether your properties are performing under or above expectation. All right. And then if you have multiple levels of properties and things like that, I really want to look at the growth per store because you can look at it from a high level property, from a fund level, not a property level, and it can mask an underperforming property. Those are kind of the main ones when I'm thinking about operating, but there's so much more, like Kyle mentioned. I mean, there's delinquency trends, there's leasing velocity. That one's actually can be pretty popular or pretty important to yours because, like, hey, how quick am I getting my leasing up and done? Renewal rates, okay? Are people actually renewing? All right. And then we started mentioning concessions, discounts. How many concessions, how many discounts am I having to incentivize to get people to stay at my property? Okay. Start going into another category here is kind of like the fund and portfolio performance. So we were talking a little bit more about at the operating level, but now at the performance level.
Feels more high level, that top line macro. Yeah.
Correct, correct. I feel like that first category is probably the most important, where most people are going to live because we're really looking at how your properties operate. Now we're getting to the fund. So what is my fund level IRR? Okay, we just talked about this. I really need to know what how well our properties are doing at the property level, but not how well is my fund doing. Okay, am I still meeting the metrics that I have? You could have one property doing really well, one property doing really bad at the fund level that kind of equals each other out, so it really gives you an idea of like, all right, how am I doing? Because this is usually what my investors are going to be looking at. Okay. It's okay. When you buy enough real estate, you're going to have a property that doesn't do as well. It happens, but how in a whole am I doing? That shows my investors how good of an operator I really am. Am I getting the rate of return that I basically promised my investors?
Daniel,
Okay.
what I see, if I can pause you, what I see a lot happen in this fund space is that investors entering a fund are kind of sold on those underlying properties individual, right? Like if I'm contributing $100,000, the GP is saying, "Hey, of that $100,000, $20,000 is going to this property, $30,000 is going to this property, another 20 here," and being pretty clear on how that's divvied up amongst the fund's actual investment portfolio. Um, and so what I see happen sometimes is investors do get stuck on the individual properties, right? And then sometimes I find that the operators or the general partners really struggle to communicate how the individual property performance feeds into the overall fund performance, both from the economic side and then just the tax reporting side and how those things overlap. So that's an area we advise on a lot. And so much of that just comes from, we're looking at static data from a year and a half ago, right? And being able to distill these metrics and KPIs in a way that we can quickly understand how the individual and the higher level blend together is super important.
Going back to the KPIs here that we just want to quickly kind of go over is just there's like equity multiples. This is another important, investors really want to know how much am I getting back? All right. So this is basically a multiple of what they've received based on what they've actually invested in capital. There's other ones like distributions to date, net asset value movement. These are all important ones. You just need to make sure that you understand, all right, which one's important to your business that you want. Going more to the debt and liquidity risk category here, this is always going to be important to real estate. One of the nice things about real estate is leverage, but you got to fully understand what leverage is because leverage is a double-edged sword, right? It can absolutely multiply your rate of return and it can destroy it at the same time. So you always want to make sure you understand where your debt is. Very, very common KPIs when we're talking about debt here is your debt service cover ratio. I would say that's probably one of the most important ones. We need to make sure we can cover our debt. Okay. Are we generating enough income to cover our debt? If that starts decreasing over time, you want to know as quickly as possible so you can take action to that. Okay. A debt yield, this one is very important to lenders and things like that. So we want to make sure that, your debt yield is usually means a higher debt yield usually means a lower credit risk. Okay. And so when we're talking about these KPIs, you're wanting to make sure that you're knowing it before your lender does. Okay. Loan to value. These are probably like the main three when I think about debt here. All right. So this just indicates my leverage. All right. The higher loan to value means more debt relative to value, which can increase refinancing risk and reduce flexibility. All right. Those I think are the main three when I think about debt. But there's a lot of other important KPIs that I want to look at. What is my near term refinancing risk? All right. So, hey, I'm getting close to having to refinance. All right. What's the market look like? All right. Is the interest rates increasing? Where, am I going to have limited options? Floating rate exposure, another great KPI here. This just lets me know if I have a lot of interest in debt that is basically going to move with a benchmark. Okay, where are those benchmarks at right now? All right, if benchmarks start moving up, dang, that means my interest rate's moving up, which basically means it's going to affect everything I have. It's going to affect my debt service cover ratio. So I really want to make sure. And then I think one that gets overlooked a lot is covenant headroom. All right. If you have a lot of loan covenants here, you really want to make sure you're meeting them all. And if you don't know where you are at any time, and this starts squeezing your covenants and you're just going to be, out of compliance, this is going to be huge issue for you with your loan. They could even call the loan on you, things like that. So you want to make sure you understand what your covenants are and that you're meeting those covenants and it's not going to be a potential issue.
This is all about managing risk, right? Like, when real estate deals go well, you get all the upside and, like squeaky. Not every deal goes that way, right? So this is just really, again, distilling this information down in a way in which you can appropriately manage your properties and get out in front of any risk across all of these areas. And make sure we fulfill our goals, that we've set out here. And, I'm jumping back to the last category we went through, but I do want to emphasize the importance of, I see this all the time in business. We budget and then we don't stick to the budget, right? Or we go through the exercise of doing a budget, but we don't maximize the potential there. And that just comes down to real-time data. And so certainly, we talk a lot about lending stress and, getting squeezed on, going through the lending process and making sure your financial records are sound for that. It's all about managing risk and making sure we're well optimized, to fill in gaps in our operations and overall performance.
Yeah. And so KPIs, these are the front end. This is our data, but where I see a lot of mistakes happen actually isn't always on the KPI side. All right. It's on the back end, configuring this, the foundation. This is where a lot of firms accidentally create bad reporting. So let's start talking about the reporting configuration mistakes that we see a lot of times. Okay. And so one of the things that we see is we just see people start building reports. They don't have any foundation. There's no one defining the metrics. They're just starting to build them. Hey, KPIs are great. Let's start building all these KPIs. And then all of a sudden you have all these KPIs, and KPIs, while most people know what it is, it could actually be different across it. So you really need to make sure that you understand there's one definition. What is occupancy? When I say occupancy, am I saying physical or am I saying economical? Okay, it's completely different here. What is my net operating income? All right, what's actually included or excluded in that? A lot of times there's things like management fees and non-recurring items. Are they included in this? All right. Even just your internal rate of return, equity multiples, a lot of these, they just need consistency. So before you configure your reports, make sure you're defining the metrics so that it's consistent across every single report.
Yeah, another big mistake I see in this area, Daniel, is, just inconsistency in the attributes, right? Real inconsistency across how we're naming things, how properties are classified. the investors and your cap table, how your investors are classified and what types of entities they are and all that getting convoluted. And so there's a lot of areas here where if you don't have a robust system, the data just gets out of control. And so I can easily tie that in with what you were just talking about, right? Where we're just building reports to build reports. We're throwing investors in there on the fly. We're adding properties without being consistent in naming conventions. All of a sudden, you're tracking NOI 4 different ways across properties that you may or may not be able to identify or getting them confused where they're at. And it just creates a system of, you're not helping streamline your process there. You're creating more problems with yourself, right? So it's intentionality on the front end. And some of this and building reports and dashboards and everything else is trial and error, right? We tweak our dashboards all the time on, little tweaks that we want to make to see data a little bit better. But before you just dive into this, you need a good system to implement. And that's where someone like us or, your advisors in this space are able to really help make sure the implementation goes smoothly.
What you'll see as a recurring theme here is consistency. Okay. Across all your properties. 'Cause what happens in this a lot of times is every property is a little different. And then when you consolidate it, it actually makes your data just confusing. Okay. And that's what we want to see is consistency at the property level, at the entity level, at the investor level, so that when everything comes together, consolidated at the fund level, it makes sense. Where inconsistency can happen is chart of accounts. Okay. If every single entity doesn't have the same chart of accounts, okay, this is what can happen. Okay. Like you basically, let's say one of your entities is recording, your contract services and repairs and maintenance, and another is recording them in administrative expenses. Okay. Or another one maybe is putting it in the payroll. All right. And now when I'm consolidating it, I have all these variances. And it's because they're inconsistent. Okay. Um, Kyle mentioned this a little bit, but your property level, your structure, basically, you need to make sure that all your structuring is the same across every entity. All right. So that way, when it rolls up, you're getting the actual data. Okay. What is truly the fund to entity relationship here? All right. And then attributes, Kyle mentioned as well. This is another one where we want to make sure we're using the same attributes across all the markets. We want to see what's the asset class, what's the strategy, what's the plan, all of this stuff, so that when we consolidate at the portfolio level, all right, we can truly see. Because when I'm looking at, hey, what is this property doing over here and what is it doing here? I don't have true optimization here at the consolidated level. I'm not actually measuring apples to apples here. All right. I'm taking two different things and I'm not really saying, hey, the framework is the same here and I can really compare them. And so now you're looking at incomplete data here and we're having a difficult time actually making those decisions. So just make sure consistency across every single property so that when it's consolidated, you have consistent data and reporting.
Daniel, we see this like having that consistency minimizes mistakes both operationally and then just on the compliance side, right? Like you talk about consolidating, a lot of times real estate's held in LLCs and there's several parcels of real estate within a single LLC, right? For tax return reporting purposes, I have to roll all those things up into one pretty tax return that goes together. And in doing that, my costs as a tax preparer are significantly reduced if everything is clean, consistent. If there's multiple different LLCs, everything's clean, same chart of accounts. They roll together the same way. We make the same 3 journal entries every year and keep it moving, right? Like that saves compliance costs. And then also on the operational side, when you look at something, you don't have to spend 15 minutes trying to figure out how does this chart of accounts work? Is this a revenue account? Is this a liability account? How did these tie into my KPIs? I know my standard set and I can see it repeated over and over and over again. And then it just helps minimize mistakes. Having that consistency in the controlled software environment outside of your Microsoft Excel, where you can just run around and do whatever you want in it. Like having that controlled software environment where the inputs and the human element to it are consistent and how it's being managed can really help optimize your business and reduce mistakes, both operationally and through compliance. And there are real dollars attached to that.
Absolutely. A few other mistakes that we just see is, try to limit Excel. Okay. Kyle and I, we love Excel. All right. And Excel is great for analysis, but it can be risky when you're using this for your reporting. All right. So just make sure that you understand that if you're using something as an Excel, if something happens, let's say like, hey, I need a number change. Well, maybe it changes in Excel, but it doesn't actually change in your accounting software. It doesn't change in your other reports. So limit the use of Excel. It's better to basically maybe use like Power BI or anything that Yardi data connects. Basically, is just a way to connect your Yardi to a more like business intelligence things, where something like Excel basically is a little bit more stagnant and changes doesn't affect everything. So limit that. That can really, unfortunately, mess up all your reports because you change one number in Excel and doesn't change anywhere else. Okay. Also, make sure you're aware of over customization without governance. All right. So I started creating all these custom reports. It's great. Now I've created a million of them. Okay. But there's too many. And we've created all these one-off reports or these ones that are very similar, same name, but one's different. No one's an owner basically to this. So make sure when you're doing your customization, there's always some kind of owner to every single report. And there should be some kind of consistencies throughout the report. So you don't have 100 different occupancy reports. And you're like, well, which one matters? And it's like, well, they all have one thing different with them. Okay. But it looks like all the same reports. All right. So make sure in it, no matter what level it at, whether it's the property managers, the asset managers, the investor relations, all of these are using the same kind of reports here, or if they are different, someone understands why they're different and able to control the reports.
Daniel, now I want to jump into just kind of integrating Yardi in the accounting function and really kind of drive home what it looks like to have this connected system where we, talk about user roles and security and who has access to what and how it makes everyone's life better, right? So starting just at the foundation here, if we're looking at this through the lens of a fund manager, accounting data has to support more than just your regular monthly financial statements, right? It's the consolidations of the properties we talked about, how things are eliminated between the properties, those overhead spends. Investors want to know distributions, right? And like have real data around their distributions, what the distributions mean for their capital accounts, their future returns, lender reporting, and then in audit scenarios, of course, having the support to substantiate what you're doing in audits. And so one of the really nice things about a platform like Yardi, and we harp on Yardi, there's plenty out there, but it creates an environment to where you can have several different stakeholders within your business and outside of your business that can get the information they want quickly and in a manner that makes sense to them. So in looking at this from like a cross-functional storytelling component, right? When you want to tell a story about your business, there's real-time data. You have the actual asset managers are going to typically be focused on your operating trends, right? Controllers are going to want the pretty reconciled numbers. That's my world, right? I want to be able to see those inputs into the static financial statements. And then your investors and the investor relations team want to see those kind of clean investor facing outputs that support the distributions, the tax allocations that they're seeing on their K1s. And then at the high level, the actual fund manager and executive just wants the more high level macro. What are the exceptions and risk indicators that I need to be paying attention to? So that is very much getting in front of that risk. And so in an environment like this, it takes your accounting function to a whole nother level because those are four very different things we're able to achieve in real time within the same platform. You've talked about Power BI a couple times, Daniel. Yardi connects with Power BI and other third-party data sources, so that, there's many different ways you can slice this to where if you do have other inputs outside of this kind of core software environment we're talking about, you can aggregate the data together from different softwares and still get good real-time information. So there's a lot of flexibility there, which is great, but also creates a lot of risk in just making this thing too convoluted. Um, the last point I really want to drive home here, and we've talked about this before, but really putting together that data flow roadmap and understanding what are the inputs to create good accounting records, good operational tracking methods that now we can use to distill this information into a way that makes sense for our team.
Yeah, great point there, Kyle. The last point we want to make here is just, we want to talk a little bit about investor reporting. Okay.
Each
So investor reporting is very important and it should always be timely, repeatable, and controlled. Okay. So Yardi has this Yardi Investment Manager. It's basically an investor portal and a CRM all included in one. This is the really way to basically automate your investor reporting, which is great because it reduces your manual compliance, which improves transparency, improves consistency. So if you really want to take that next step in that investor reporting, there's a lot of automation this can have here, where now this portal provides access to your investors with all these metrics and reports, the ones we just talked about here. And now you're automating all your quarterly statements and things like that, and all of these KPIs. And now your investors can take a look at it, because if you're just really easy ways to be able to provide transparency to your clients and make it easier by you by setting up automation.
Daniel, this investor reporting needs to be clear. I see at times underperforming funds have lost the trust of their investors. And while part of that is disappointment in fund performance, those conversations normally get back to just the communication from the fund is not clear and transparent, right? So you talked about how the system has to be timely, repeatable, and controlled. Crystal clear as well, right? So what we like to see and what a software package can really help you get your hands around to give good, clear, timely, real-time data is instead of just here's your quarterly investor statement, have a good day, right? It's here's how the portfolio is performing now, what it did last quarter. Here's what we're watching this quarter. And here's how that in fact impacts the investment thesis we threw at you day one that got you to sign that dotted line, right? So it's connecting that. What is that? The recent performance. What are we looking at for the future? How does that tie back to what you agreed to? Is really what I see moves the dial most in retaining and growing the trust of your investors, especially if performance of certain properties or the fund is lower than anticipated.
Hope this video today helped you kind of just a little bit understand Yardi or your property management software so that you can be getting the most out of it. And so stay tuned for next time, and we'll give you more helpful tips in the real estate industry. Thank you.